Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Tuesday, December 22, 2015, and it's pretty much playing out like we discussed last night. Here comes the Santa Claus rally. There's no reason the market should not continue higher. We discussed an up market today, most likely tomorrow. I've got our zone in here. The blue dotted line is where we opened the year. I believe this line represents the closing price of December 31, 2014. The 206 would be my upside target in terms of what my expectations are for the upside. And I'm not suggesting it all has to happen tomorrow, although it could. But before the end of the year, that's what I would expect to get to. And that would be pretty good. We should get a pretty good reaction off that point. I'm not suggesting shorting it today because I don't know how we're going to get up there. If we consolidate below that area, for example, let's say we got up to 205 and began to go sideways for 4 or 5 days, then things change. So let's just leave it as it is right now. There is a distinct, well, I shouldn't say distinct. There is a slight possibility that we can actually just have a melt up tomorrow. I don't really have anything substantial as to why I would say that, other than I just don't think we're going to see any downside pressure in the market. And with no downside pressure, tomorrow could be one of those typical trend following days upward, and it could just be just one of those melt up days. I'm not saying that's going to happen. I'm saying that could happen. Don't necessarily, buy something long tonight in the aftermarket, meaning in the futures market, or first thing tomorrow thinking that's going to happen. I'm just saying that if you see a trend day with light volume higher, my expectation is that would last throughout the day. I don't really have anything substantial as to it has to happen, because I just have a sneaking suspicion that that's what I see happening. But when we do get up to the 206 area, I do see a lot of resistance up in that point for a number of reasons. The first reason is it's a mathematical, it's easy for you to say, a mathematical calculation. The second reason being it's a convergence of all the moving averages, the 20, the 50, and the 200 period moving average. And it's also slightly above where the year becomes a positive year. And I think from a psychological standpoint, that's a big deal. Those three things are a big deal put together. So I do anticipate seeing a lot of resistance up in the 206 area. Okay, so that's pretty much everything I know in the market. I do not expect downside pressure tomorrow. If we did see that, anything is possible, of course, but my expectations are for another up day in the market. The IWM. The IWM had a day on par with the S&P. The S&P was up 1.16%, and the IWM was up 1.09%. Now, the SPDR was up just about 105 million shares, which isn't bad. Let's go back to that for a second. It's not terrible. It's actually more than yesterday, and it's less than the average, but more than yesterday. It's down here. The volume is found down here. But let's go back to the IWM, which was up on par with the S&P. So therefore, we're not going to read anything too much into it. Where could the IWM get to if we see my targets hit on the SPDR? 115, 115.50, in that neighborhood, right up in this zone here. That would be about it. I think with the convergence of the moving averages, right in here would be my expectation for a stall out of the IWM. And you'll note that the IWM is still the weaker index, and it's still below, comfortably below, the upsloping trend line drawn over from the monthly chart. That's very, very important. When we close this month, assuming we do, if we close this month, let's take a look at that real quick. Assuming we close this month below this line, okay, that's significant. It's just telling me that the IWM is very, very heavy, and it begins forming the head and shoulders pattern that we talked about a few nights ago. And the downside target on the head and shoulders pattern we started talking about a few nights ago is all the way down in this zone here at around $84, $85 per share. And that also has other significance. It became a mathematical calculation. It's also a pivot high from over here in this zone here. So there's a lot of support in this area, and there's a lot of draw into this area. But keep in mind, like we discussed the other day, this is a monthly index. So don't expect this to play out A, all at once, or B, anytime soon. This would take the better part of, it could take 18 months to play out. It could take shorter, it could take longer, but this is not something that we would expect to play out by like March. That's not the way it works. You're going to have a lot of support in the area where the head and shoulders neckline resides today. It's not going to just cut through that neckline like a knife, a hot knife through butter. Okay, there's a lot of stuff going on a monthly chart. So I don't want to give you the wrong impression. I just want to give you the long-term view. And that's about it. So let's go over to the transports. Transports were up 1.5% today, 111 points. And that's pretty strong. And as you can see, we're getting a nice bounce again off of this downsloping trend line. Where does this come from? Let's go over to the weekly chart, and you can see that the transports are fighting this downsloping trend line. Okay, you don't think these trend lines are important? Well, I know you guys do, but these trend lines are very, very important. You can see it's not me drawing in the trend line. It's the market drawing in the trend line by virtue of where it finds resistance and support. And where the market finds resistance and support becomes the platform or the roadmap for where these trend lines are drawn from. And the market tends to adhere to or respect these trend lines, and that's why we draw them in. And as you can see, right now we're above the trend line, so the question is for the transports, where can we go? Well, based on just the math alone, we can certainly get up to 7,600, maybe 7,650, and that would give us a nice, continuation rally in the transports. And of course, if the broader markets rally, then you can expect the transports to follow. But let's just say that, let me show you where 76 to 7650 is. It's here to here. Okay, this is the zone. So if it did rally to that zone, and you just looked at it from the larger perspective, okay, all that really becomes is a down move and sideways consolidation with some, back and forth in this zone. And if that's the case, and it couldn't get really above the moving averages, which are downsloping, transports are below on the daily chart, below all the moving averages, then this is really setting up for a bearish pattern to go lower. And that would be my expectation into first quarter of next year. So just wanted to give you my thoughts on the transports. Let's move on to the gold market. Gold sold off a little bit today, but in my book, as long as we're above the 1061 area, there's not a lot of trouble up here. It's going to bounce around. It's really trying to fake everybody out. Gold is really wreaking havoc on a lot of traders. I can tell you that. I have, several friends that are traders. I have a lot of people I know that trade in the commodity sector, in the metals market, in the crude oil market and such. And, frankly, it's just been wreaking havoc on a lot of traders. It's basically chopping a lot of traders up in this, last month or so. And that's basically what markets are designed to do. It never really makes it easy for anybody. There's really not many trades out there that are just easy. Some of them you can see coming, and some of them work out just like we map them out. But in large part, especially in the commodity complex, especially in the metals, the metals market, gold in particular, just doesn't make it easy, and it's not making it easy now. My guess is we still may come to back test the 20-period moving average, which is this sloping, this flattening out, red sloping trend line. And that could certainly happen in the overnight market. It's only 3 points away, give or take. So my expectation is we would probably see a test of the 20-period moving average. If we got down below 1061, I would begin to be concerned that we're not going to see the upside momentum in gold. But if we remained above 1061 through the remainder of this week, then my expectation is we're going to see the higher prices that we've been discussing, namely 1100 up to 1110, which is the red line here. We should see a nice reaction on the downside from 1110. The 1075 is important. We're now below it. I'm going to put in a 1061 line since I took out the fibs from the 60-minute chart. Just bear with me. All right, so I made it a red line only because it is a line in the sand, and I made it 1061 even. I know the fib was slightly more than that by less than $1. I don't remember exactly what it was. It's not really important. A close below 1061, and I'm concerned that the upside's not going to happen. So that's my stance in the gold market. Let's move over to silver, and silver scratched out a little bit of a gain today. And believe it or not, that's a positive development for gold. As crazy as that sounds, it is a little bit of a divergence, and it's a positive divergence. And I'm going to read that as suggesting that a positive divergence is kind of holding somewhat of a bid underneath the gold market. It's not a definitive, line in the sand for me. It's just something that I like to take note of. Any kind of positive divergence, I like to just note. I kind of have it in the back of my mind. But all in all, the same thing applies for silver that applies to gold. They're going to go in the larger picture in lockstep. They certainly don't trade together on a daily basis all the time. But if gold's going to rally up to my number, up, $30 to $40 from here, then silver's certainly going along for the ride. But again, my line in the sand is drawn in gold. But I like the positive divergence in silver today. I don't talk about GDX a lot, but I know some of you like to trade in the gold miners. This is a tough one. This is it's kind of a bearish pattern inside of a bullish pattern. And I know that sounds a little quirky, but let me explain what I'm seeing here. So you have an up move, okay, and then you have a pullback pattern. And this pullback pattern is a bullish pullback pattern, potentially for another up move higher. The problem is, and there's a couple of problems here. One problem is you're below all the moving averages. That's a negative. The other negative is you're also inside of the bullish pattern I just cited, you have a bearish pattern, okay? So I don't like that, and those things put together alone would just keep me away from trading GDX. Obviously, it's not obvious, but if gold gets pulled up to 1100 to 1110, I would suspect that GDX will go along for the ride as well. But I just don't like when I can't definitively tell you that there's a pattern that's in place. When I see a pattern inside of a pattern, it just keeps me away from it. Sometimes the best trade is the no trade. And if we look at it on the hourly chart, this is a bullish pattern on the hourly chart. So here you have an up move, okay, and you have sideways, very, very sloppy sideways consolidation, generally looking for another up move higher, but also on the hourly, you're below all the moving averages. So here again, I'm not in love with this chart. Personally, it's not for me, but I just wanted to give you my thoughts because I know a lot of you like the gold mining stocks, and that's fine. So I thought I would give you my thoughts. Let's go to the crude oil market, and we're now obviously in the February contract, and this is the hourly chart. The hourly chart looks bullish to me, above the 20 and the 50 period moving average. We had an up move, made a little bottoming tail on the hourly chart, an up move off of that. bottoming tail. And again, this is just the hourly chart. This is where we left off the last one. That's why the hourly came up. And, we're trying to make a move higher. Does it get through 36.50? Maybe it does, but you're going to find a lot of resistance up in this zone here. First at 36.75, and then, of course, at 37. We'll just round it up to $37. But let's go back to the daily chart and see what we've got. So, on the daily chart, again, just like I've been saying for many, 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 many days, it is going to carve out a bottom. We just don't know whether this is it or not. What we really need to see is and I know I sound like a broken record, we need to see the high volume reversal day. This wasn't it. And yesterday wasn't necessarily a doji. I mean, it is, but it's not. It's nothing we can hang our hat on just yet. But it is, it's trying, but it's below all the moving averages. At minimum, we have to see a close above this high here, which is basically 37.08 on a daily. I'm sorry, wrong number. Pardon me. 38.53 on a daily chart closing basis. And I know that that's far away from where we are. And by the time we get there, people feel like you missed the move. So what I'm looking for, and the only way, there's two things I'm looking for with crude oil or any chart that looks like this. When charts are making new lows, okay, let me back up. We're in the risk business, but we're also in the high probability trade business. Okay, we're not in the business of guessing at where the bottom is. That's a fool's game. We could have guessed the bottom in crude oil 5 to 10 times already and been wrong. So what we're looking for is we're looking for either a high volume reversal day where we see a significant rally off of, ideally we want to make a low, reverse higher, and finish near the highs on volume. That's the ideal scenario. It's not always going to give us an ideal scenario. The second thing we're looking for is a pattern. So say we get some kind of an up move. Say we get up to this, say we get up to this level here at 38.5, just for argument's sake. Okay, so let me draw it out. We get up to 38.5, all right, and everybody feels like we missed the move. The likely scenario is at that point, we begin, just when everybody in the media begins to get bullish and say that crude oil has bottomed and that higher prices are coming and $50 are coming and $80 are coming, and Boone Pickens shows up on TV and says $75 is coming, like he's done, a half a dozen times. Basically, what then will generally happen is we'll begin to start to see a pullback. Just when the media gets bullish, we'll see a pullback, okay? And that's at the point in which we begin to pick a spot to get long for the next move higher. That's what we're looking for. We're either looking for the high volume reversal day and then a pattern, or just the high volume reversal day and then you have something to trade against because you know that if it breaks the low, then we were wrong. And that's how you play not just crude oil, but any chart that's making new lows consistently. That's the only thing on the probability basis that you can do in order to find a low to trade against in a stock or a commodity or any chart like this. Okay, so take that for what it's worth. Let's go over to the bond market. And the bond market had a little bit of a down day. We came into the 20-period moving average. Our bonds going lower or going higher. It's actually very hard to tell right now. And one of the reasons being is, and I've been talking about this channel pretty much for, the better part of 3 or 4 or 5 days now. And as you can see, this is a bullish or upsloping channel. And I told you that if we came to the bottom end of the channel, it could potentially be worth a trade if you're a bond trader. At this point, I would be looking for support at the 50-period moving average. I know I don't like the fact that I draw this in with my mouse because it's sloppy. I apologize. I should have drawn it in with the charting tool, but nevertheless, it's better than I've done the last few nights, to say the least. The 50-period moving average, I'm going to get rid of this. The 50-period moving average comes in right here, the blue line that's running across the chart here, that's leveling out. Now, you'll probably find some support there, and if in fact the bond market was going to continue higher and find support at the bottom end of the channel, what you would generally see is support at the point in which the channel is. So let me just do this, okay? And here, see this, I don't love this channel. The more I look at it, the more I'm not in love with it. I mean, here's your channel. You pierced it a couple of times, but technically it has to be drawn in like this. And if I want to draw in the top of it, technically it has to be drawn in like this. And the top, it's not even great. Let me do this over. And bear with me, folks. I apologize for doing this with you real time. But, you know, I really want to kind of... That's okay. This channel is fair. It's not the best channel in the world, but it's fair. My point is that if you closed below the 50-period moving average, you would have therefore closed below the channel, and I would not want to be long because you would most likely test at minimum of the 200-period moving average. It's not a great trade. That's the bottom line. The more I look at it, the more I talk through it with you, the more I just decide it's not a great trade. From a Fibonacci perspective, it's probably, I think we've done this before, it looks to be about the 50% retracement. If I draw the recent high to the recent low, the 50-period moving average comes in at the 50% retracement. That was kind of obvious. You can eyeball that one, which tends to be the bottom end of this channel. You know what? It's not bad. It's probably worth a trade if you're a bond trader. If you trade in treasuries, it's probably worth a shot with a relatively tight stop. I don't know how much. I don't know if I would even give it much below 54.09 on a minimum of an hourly chart closing basis, 154.09, which is this green bar high or low. Pardon me. I'm just talking it through. You know, sometimes I do that with you just so that you can see my thought process as I try and understand what the likely scenario is without doing, you know, any kind of significant mathematical calculations, just looking at chart patterns, looking at channels, looking at Fibonacci retracements, looking at all the things that we can visually identify on the charts. And it's really just supposed to be and designed to be a learning opportunity for those that are trying to learn how to do this for themselves. That's the goal. The goal is you don't need me anymore. That's really what this whole thing has always been about. So let's move on to the dollar, and we'll leave this alone. You've kind of have my thoughts in the bond market. So the dollar, came down today. And I'm not convinced that the dollar is finished on the downside. I've been telling you that. To me, this is nothing other than a bearish pattern, a down move, a very choppy, sloppy wedge pattern. And I think that this just goes to the 618 retrace. I've been telling you that evening after evening after evening. Whether or not it gets to that target, maybe it stops short at the 200-period moving average. That's certainly possible. Maybe we just test the 50% retracement, pierce through it one more time, and that's it. That's certainly possible. If you're looking to get long the dollar, I would begin to get long at the 50% retracement around 97 and change. Maybe look for 97 and be prepared to add some at the 618. I think that's a fair play. And I think with that, you know what? There is one other thing that I wanted to make mention of. Apple. I talked about Apple a few times over the last few days, telling you that we should find good support in and around the 107 and change area. And, it definitely went lower. But as you can see, Apple did not, for one, participate in today's rally. That's suspect. However, it is holding this area in and around the 107, give or take, area. And if we do see a melt up tomorrow, I have to believe that Apple would finally participate in the rally. And that's just my 2 cents for what it's worth. I only bring it up because I've been talking about it the last couple of days, and I thought it was worth mentioning because I know some of you have taken an Apple trade on the long side, so I want to kind of keep you in the loop on my thought process. Nothing more, nothing less. I just find it suspect that it didn't participate today, but if we do get some kind of a melt up tomorrow, which is possible, I do have to believe that Apple participates. That's just my gut feeling. Nothing more, nothing less. So with that, we're going to leave it there tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.